Welcome to today's Explainer. Look, Western Digital just took a massive hit, dropping a staggering 7.4%. Now, in the fast-paced tech world, a single stock dropping might not normally sound the alarm, but this one? Well, it's a bit different. It actually sets up a pretty fascinating central mystery for us today. If the AI business is booming louder than ever, why are the very companies supplying the critical storage for that infrastructure suddenly crashing? Are we just seeing investors skimming off some quick profits? Or are we witnessing the start of a much larger, fundamental repricing of the entire AI ecosystem?
Okay, let's dive into this. Negative 7.4%. That is a brutal drop for a company of Western Digital's massive scale. It's the kind of sudden shock value that completely grips the market and forces everyone to pay attention. But honestly, that 7.4% decline isn't actually the number that should immediately concern AI investors the most. It's what's happening around it that tells the real story. And here is our first real clue. Just look at the broader pattern. SanDisk fell roughly 9%, Western Digital dropped at 7.4%, and Micron slid about 7%. The broader semiconductor sector as a whole fell roughly 5%. Yet NVIDIA? It declined only around 2.3%. This clearly shows us that memory and storage stocks are getting hit significantly harder than the undisputed poster child of AI chips. This isn't just one isolated stock having a bad day. We're seeing a highly specific pattern developing across particular parts of the AI hardware ecosystem.
Which brings us to the absolute elephant in the room. If data centers are being built at a record pace right now, and AI demand is unequivocally booming, why are AI infrastructure stocks, the companies quite literally building the foundation of this technology, getting crushed? Why are they severely underperforming the biggest AI names out there? Well, to figure that out, we need to gather a few more clues about how this whole ecosystem actually fits together.
Think about what a company like Western Digital actually represents today. They aren't just cranking out hard drives for your laptop anymore. They are a core piece of the storage infrastructure behind the entire modern data economy. AI models generate absolutely massive data sets. Companies have to store those data sets, and they have to be able to retrieve that information at lightning speed. Increasingly powerful AI systems require increasingly sophisticated infrastructure to hold all that knowledge. Logically, you'd think this should be a massive, unquestionable win for storage companies, right?
But here's the thing. The AI infrastructure trade isn't one single monolithic business. It's more like a giant interconnected chain. You need the GPUs, the memory, the storage, networking, the physical servers and data centers, and of course, you need massive amounts of power and cooling. And here is the catch. When expectations become astronomically high for the entire chain, and one single link, like memory or storage, starts coming under pressure, investors immediately start sweating. They worry that the pressure is going to spread down the line to literally every other link in this ecosystem. And this brings us to a glaring paradox. Out in the real world, hyperscalers are spending billions, and the underlying AI business remains incredibly strong. Yet out in the stock market, AI stocks are still falling. But you know what? These two things actually aren't contradictory at all. A strong long-term industry does not automatically guarantee that every related stock goes higher every single day.
Because stock prices, after all, are driven by expectations. Investors have already spent the last couple of years pricing enormous AI growth into these companies. So the question the market is asking is no longer, will AI grow? We already know it will. The real question is, will AI grow fast enough to justify today's astronomical expectations? When those expectations are essentially priced for perfection, even good companies with really solid fundamentals can suffer violent sell-offs at the slightest hint of friction.
Section 1. The macroeconomic suspects, Treasury yields and oil.
Okay, here's the first domino effect. When bond yields rise, growth stocks inevitably come under pressure. Why is that? Well, because investors are constantly comparing the potential risky return from stocks with the guaranteed return they can get from bonds. Plus, tech and semiconductor companies are often valued based on the massive earnings investors expect them to generate years into the future. When interest rates and bond yields go up, those future earnings suddenly become a lot less valuable in today's math. That creates immense valuation pressure, and boom, high-growth tech stocks fall.
Now you add oil to the mix, and the chain reaction gets even more complex. Higher oil prices naturally increase inflation concerns. If investors get spooked about inflation, they assume interest rates won't be cut anytime soon, which then pushes those Treasury yields even higher. And exactly as we just discussed, higher yields mean growth stock valuations take a heavy hit. Suddenly, semiconductors and AI infrastructure stocks are selling off. When you view it through this lens, Western Digital's 7.4% decline looks
Well, actually scratch that. It looks less like an isolated issue with one company and way more like collateral damage in a much larger macroeconomic debate.
So, with all of this macroeconomic pressure bearing down and falling stock prices across the board, it forces us to pause and ask a very serious question. Is AI demand actually weakening?
No, absolutely not. And it's extremely important we make this distinction right here. A stock market sell-off does not equal a collapse in underlying business demand. Data centers are absolutely still being built. AI models are continuing to become exponentially more computationally demanding. Storage remains an utterly essential pillar of the digital economy. So there is absolutely no reason to look at a 7.4% drop in Western Digital and conclude that AI is over. It just means the market is ruthlessly questioning valuations. Knowing that the demand is real but the market is nervous, we need a structured way to understand future market movements.
Section 2. What happens next? 3 potential AI scenarios.
First up, the green light, the bull case. In this scenario, the underlying demand story remains perfectly intact. AI infrastructure spending doesn't just continue, it accelerates. Hyperscalers keep expanding their massive data centers. Consequently, the demand for memory and storage to handle all that AI-generated data grows rapidly. If this plays out, then today's dramatic sell-offs are really nothing more than a healthy, temporary valuation reset. The stock takes a hit today, sure, but Western Digital and its peers eventually win big as the massive build-out continues. Now for the yellow light, the base case. This one's arguably a bit more complicated. Here, AI demand stays strong, but the era of blind hype, yeah, that ends. Stock valuations are forced to become a lot more reasonable. Investors are no longer just going to buy any ticker symbol that slaps AI on their press release. Instead, they're going to demand hard proof. They'll want to see actual earnings, free cash flow, healthy margins, and a truly defensible competitive position. The market becomes highly selective. In this environment, Western Digital remains a vital infrastructure company, but it might not be a straight-line rocket ship stock winner.
Finally, we hit the red light, the bear case. This is where things get genuinely dangerous for investors. In this scenario, AI infrastructure spending eventually cools off. At the exact same time, companies have already ramped up their manufacturing, so memory and storage supply increases, which completely weakens their pricing power. Now you're facing a deadly double hit. Earnings expectations fall rapidly, while elevated Treasury yields are simultaneously compressing valuation multiples. When you combine lower earnings with lower multiples, the declines can be brutal. Suddenly, a 7.4% drop seems like just the tip of the iceberg.
And this brilliantly illustrates the most important lesson of this entire explainer. You absolutely must separate the AI revolution from the AI stock trade. Yes, they are deeply related, but they are absolutely not the same thing. Trillions of dollars can, and very likely will, be invested in AI infrastructure. The technological revolution is undeniable at this point. But the stock market, that's a completely different beast, driven by expectations, interest rates, and multiples.
So the crucial point boils down to this question right here. Who actually captures the profits from all that spending? Just because a massive data center needs storage doesn't magically mean the storage provider gets to keep all the money. Individual companies still face fierce, cutthroat competition. They face brutal margin pressures, and as we've clearly seen today, they face serious valuation risks if they don't grow fast enough to satisfy Wall Street.
Which leaves us with this final provocative thought to ponder. When you look at the broader pattern we discussed, SanDisk down 9%, Micron down 7%, Western Digital down 7.4%, all while NVIDIA barely flinched, you really have to ask yourself, is Wall Street simply correcting a few isolated memory and storage companies like Western Digital? Or are they becoming incredibly selective, demanding proof of profits, and quietly starting to sell off the broader AI infrastructure trade? Thanks for joining me for today's explainer. I'll see you next time.